How to build a discounted cash flow model in Excel. Let me walk you through the DCF model that I built for a valuation of US telecom company Verizon. I hope it provides you with insights into the practical side of doing a DCF valuation. A quick overview of the structure of the DCF model. Line item descriptions in column A, 3 years of historical actuals in B, C and D, and then 5 years of estimates. My discounted cash flow model works from left to right. Oldest year on the left, and if you go to the right, you go forward in time. For the years where I have historical actual data, I put an A next to the year. The source for the actuals is the 10K annual report. When forecasting future years, I put an E for estimate next to the year. The source for the estimates is short-term company guidance combined with my personal educated guesses. All of these assumptions could turn out to be wrong. The future has not happened yet and will be much weirder than we can imagine. So don't take any DCF model too seriously. I have frozen the top rows in the model so they stay visible while scrolling through the rest of the worksheet. A high-level overview of the line items in the DCF Excel model. We start off modeling the P&L, or profit and loss statement. Revenue, gross profit, operating income, all the way down to net income. Then, using the indirect format of the cash flow statement, it goes from net income to cash from operating activities. CFOA minus capital expenditures equals free cash flow. That's a very big and important line, and pretty much the whole reason we built the DCF model in the first place. The rest of the model is about applying the time value of money. It covers how to apply the WACC to get the present values of the forecasted future free cash flows. How to calculate the terminal value. And works through enterprise value and equity value in order to end up with the estimated value of the share price. A lot of people use the discounted cash flow method in order to decide whether to buy, sell or hold a share of a publicly listed company, based on comparing the estimated value in the DCF Excel model to the current market price and identifying either upside or downside potential for the stock. All of the analysis and forecasting happens in one single Excel worksheet. The process of building a discounted cash flow model in Excel is as important as the outcome of the calculation. The process provides you with a lot of insights into the value drivers of the company. Now let's go through the setup of this DCF Excel model in more detail. Revenue is a hugely important section of any discounted cash flow analysis. The Verizon income statement for external purposes has 2 revenue lines, and I will follow that format in my DCF Excel model. Everywhere in this spreadsheet I'm using the formula text function to display the formulas I'm using in blue, just below the line that this formula resides in. On the Formulas tab, use Trace Precedence to visualize the inputs for a formula. So for example, total revenue is the sum of the 2 revenue line items. Revenue growth equals current year revenue divided by prior year revenue minus 1 and displayed as a percentage. Throughout the file, all input cells are marked in yellow. The other cells are calculated values. Some people also like to color code historical data versus forecast data, but I'm not that colorful. For revenue growth, I'm forecasting at the total level, not on the individual line items. I started from the 2024 guidance issued by the company, made the very bold assumption that this growth continues over time, and applied the higher end of the range for the first 3 years, and then the lower end of the range for the last 2 years. The row of total operating revenues is now the output variable. Current year revenue equals prior year revenue times 1 plus the growth rate. That formula repeats for each of the forecasted years. A lot of formulas in this DCF Excel model will refer to this row 6 of total operating revenues. When you incorporate the cost of services sold and the cost of wireless equipment sold, you can calculate gross profit by deducting those costs from revenue. The way I prefer to look at it is on a relative basis. What is the gross margin percentage? if we divide gross profit dollars by revenue dollars. Gross margin percentage by type of revenue and gross margin percentage overall. Revenue mix is very important as there can be very different gross margin percentages for each business. For gross margin percentage forecasting, I chose to keep that constant at the 2023 levels of 59%. This percentage now feeds into the gross profit dollars line, as we can see when using trace dependence in the formulas tab. The formula in the gross profit line for the forecasted years multiplies total revenue by the gross margin percentage. The cost of services and goods sold is in turn an output variable when using this forecasting logic. If the forecasted revenue is $138 billion and the forecasted gross profit $81.4 billion, then the cost of services and goods sold must be $56.6 billion. On to selling, general and administrative expenses, in short SG&A, another major cost line in Verizon's P&L. This is a tricky one, as there are parts of SG&A that are recurring and can be used for a trend analysis, and other parts that are supposed to be non-recurring special items. Once the special items in SG&A are isolated, we can calculate core SG&A as a percentage of revenue and get to a pretty consistent 22% to 23% of revenue, which we can use in our forecasting exercise for future years. I am forecasting core SG&A stable at 23% of revenue, so if revenue goes up, then SG&A goes up at a similar rate. Core SG&A dollars equals SG&A as a percentage of revenue times revenue dollars. Special items could go either way, positive or negative, so for forecasting purposes, let's keep these at 0. Next up is depreciation and amortization expense. This isn't usually split out separately in the company's profit and loss statement, but Verizon does so as it's such a large and material amount of expense for them. We see a steady increase in depreciation and amortization, which is largely related to the step up in CapEx spending in the past few years. For the forecasted periods, I assume that the absolute dollar number increase from 2022 to 2023 is recurring. Current year depreciation and amortization equals prior year depreciation and amortization plus $500 million of increase per year. And if this depreciation and amortization forecast is off, then it's good to know that you add back exactly the same amount anyway in the non-cash adjustments further down. The main financial impact on the discounted cash flow model is that depreciation and amortization is a tax-deductible expense. So the higher the depreciation and amortization, the lower the income before provision for income taxes, and the lower the provision for income taxes. 2023 had a large charge in the income statement related to goodwill impairment. This one-off non-cash expense significantly impacted the 2023 results as far as profitability is concerned. For forecasting purposes, let's assume this is not recurring. Total operating expenses is a subtotal that adds up 4 different rows in the model. The cost of services and equipment sold, SG&A, depreciation and amortization, and the goodwill impairment. Be very careful here. Different companies use different operating expenses in a different way. For Apple, for example, operating expenses equals the sum of just 2 line items: research and development expenses and selling, general and administrative expenses. So that is a narrower definition than the one Verizon uses. Operating income in the Verizon P&L is total revenue minus total operating expenses. Here it is useful to do both some horizontal as well as some vertical analysis. Horizontal analysis versus prior period. Operating income growth percentage equals current year operating income divided by prior year operating income and deducting 1 from the outcome. That gives us the horizontal year-over-year comparison. The significant decrease in 2023 is largely driven by the one-off goodwill impairment expense, and so is the significant increase in 2024 when there is an absence of goodwill impairment. Vertical analysis as percentage of revenue. Operating income as a percentage of revenue gives you a really good way to compare and benchmark companies and to follow the profitability trends over time. This is not an input, but a very important outcome to check. An operating income of 23% of revenue in the forecast is in line with the 2021-2022 actuals. So I don't think the forecast is overly aggressive here. From operating income, it's only a short way to net income. First off, other income. Income that does not come from a company's main line of business. Just like in selling general administrative expenses, there are a lot of special items included in this line that make the total other income swing up or down significantly. Once those special items are separated out, the core other income seems to consistently be a small positive number for the company. Interest expense. My forecasting shortcut here is to take a run rate approach. Take the actual number from the latest quarter, which when making this video is Q4 of 2023, and annualize that. 4 times $1.6 billion is $6.4 billion. I'm keeping that amount the same over the forecasting period. Income before provision for income taxes is also known as pre-tax profit. It equals operating income plus other income minus interest expense. Below that line is the provision for income taxes. Once you know those two numbers, you can calculate the key value for any DCF analysis, the effective tax rate. Provision for income taxes divided by income before provision for income taxes. Note that this is one of the very few line items where you do not divide by revenue. For the forecasted periods, the provision for income taxes equals pre-tax profit times effective tax rate. Net income, or the bottom line, gets us to the end of the income statement or P&L. Income before provision for income taxes minus provision for income taxes. Just like with operating income, it is useful to do both some horizontal as well as some vertical analysis. Horizontal, current year net income divided by prior year net income and deducting 1 from the outcome. Vertical, net income as percentage of revenue. Just like the operating income percentage, this is not an input, but a very important outcome to check. At 14 to 15% of revenue, this is lower than the 2021-2022 actuals. So once again, I don't think the forecast looks overly aggressive here. The next section of the DCF model is something that might feel unfamiliar to a lot of people. You have to study the cash flow statement, more specifically, the indirect method of cash flow reporting, in order to understand this section. Cash from operating activities is different from net income, as things are measured on a cash basis, not an accrual basis. Therefore, non-cash adjustments are needed to get from one to the other. The first, most obvious, and in the case of Verizon, by far the largest item, is depreciation and amortization. In the income statement, you deducted depreciation and amortization as an expense, which lowers the pre-tax income and the provision for income taxes. Now you add it back, as depreciation and amortization are not paid to anybody. You perform the depreciation and amortization add back on both the actuals as well as the forecasted numbers. Next are 6 lines of adjustments where the timing of recording the expense and the timing of actual cash outflows are different. In most cases, the cash payments happen later or possibly not at all. Numbers between brackets are cash outflows. The others are cash inflows. Forecasting the adjustments from net income to cash from operating activities is an area where you have to be cautious, just when forecasting fatigue might be setting in. Most line items are not so straightforward. You may have to go into some detail to understand each line item and look further back than just 3 years to get a feeling for the range of possible values. Or you take a shortcut. I have added an analysis line called total adjustments versus depreciation and amortization, which take the sum of the adjustments and divides it by just a line of depreciation and amortization. In 2023, this gives an unusually high value of 144%. due to the high value in the line of goodwill impairment, which is a one-off item. To normalize the trend, we can calculate the same percentage excluding the goodwill impairment line. This shows us that historically, the total adjustments tend to be slightly higher than just depreciation and amortization, 102% of that value. That can be used as a control value, or as the way to forecast the whole category without diving into too much detail. A forecasted sum of the adjustments, as percentage of depreciation and amortization, between 105% and 106% seems nicely in line with the historical percentages. Cash from operating activities is the next important subtotal in our DCF Excel model. Net income plus the sum of the adjustments. A quick horizontal check on the year-over-year trend is a good control line here. The CFOA year-over-year growth seems very much in line with the revenue growth that we started with. Let's see what that looks like. Capital expenditures forecasting. Fairly easy for 2024, as Verizon provides guidance in that area. I have taken the middle number of their guidance range. The drop in CapEx is happening now that the peak investment years for the 5G rollout have passed. For the outer years, I assume that CapEx spending has to grow versus the 2024 baseline in line with revenue. The formula for forecasted capital expenditures dollars is prior year number times 1 plus the growth rate. Cash from operating activities minus capital expenditures equals free cash flow. The 16% forecasted free cash flow growth versus prior year in 2024 is a one-off. The result of 4% forecasted CFOA growth and a 7% decline in CapEx spending, respectively, versus the prior year. Let's translate the free cash flow estimates for future years into present values. For that, we are going to need a WACC, weighted average cost of capital, as well as a terminal value growth rate. For the WACC, I base my fairly low 7% on an online search for the Verizon WACC, as well as a rule of thumb for stable and mature companies having a WACC in the 6% to 9% range. The 2% terminal value growth rate reflects company guidance for the first year of the forecast period, as well as the expected long-term growth rate of the US economy. The further out into the future the free cash flow occurs, the lower the present value will be. The nominal free cash flow estimates in the valuation are linked one-to-one with the free cash flows in the forecasting model above. There are three ways that I see people tackle the translation to present values, and each one leads you to the same outcome. The first method is to divide by discount factors for each of the years. The discount factor is 1 plus the WACC to the power of the number of years. So 1.07 for year 1, 1.07 times 1.07 for year 2, and so on. I'm displaying these factors rounded to 2 decimals. The further out in the future, the higher the discount factor. Now divide the estimated nominal free cash flows by the discount factors. $21.7 billion divided by 1.07. $22.4 billion divided by 1.14, and so on. Those 5 numbers you can then sum to get to the present value of the free cash flows in the forecasting period of $94 billion. The second method is to multiply by a discount factor. We use the formula 1 divided by 1 plus the WACC to the power of the number of years. In other words, we perform the division at this earlier stage already. 1 divided by 1.07 is 0.93. 1 divided by 1.14 is 0.87. Then in the row for the present value of the free cash flows, you multiply the 2 lines rather than divide. Sum those 5 values and you get to $94 billion. Third way to do it is to use the NPV formula in Excel, which references the cell in our Excel worksheet where the WACC is located and applies it to the cells that contain the nominal, undiscounted free cash flow numbers. Guess what? Using this formula also gets us to $94 billion. I tend to put both the first and the third method in my DCF Excel models. just to make sure I don't make a calculation mistake in this very important section. Check, check, double check. Next, we calculate something called the terminal value. What is the estimated value of the free cash flows of the company for the time periods after your last projected year, all the way until the end of time? You start with calculating the free cash flow input for the terminal value, which is usually done by taking the free cash flow in the last year of the forecasting period and multiplying it by the terminal value growth rate. $24.3 billion times 1.02 is $24.8 billion. To translate that single free cash flow number to the terminal value beyond year 5 all the way to eternity, you divide by the WACC minus the growth rate. In our case, $24.8 billion divided by, between brackets, 0.07 minus 0.02. The evaluate formula tool in Excel comes in handy to view the steps in the calculation. The terminal value works out to a momentous number of $495 billion. However, that's the estimated terminal value in 2028, 5 years from now. That amount needs to be brought back to today's equivalent as well. $495.5 billion divided by year 5 discount factor 1.40 equals $353 billion. Now we can add up the present value of the free cash flows in the 5-year forecasting period and the present value of the terminal value. This leads to an estimated enterprise value of $447 billion. Nearly 80% of that enterprise value is driven by the terminal value, which is an unusually high percentage, even for a 5-year forecasting period. Much of this is driven by the relatively low WACC of only 7%. Enterprise value to equity value. Take the enterprise value we calculated, add cash and cash equivalents, deduct that, and we get to an estimated equity value of nearly $299 billion. We are now getting very near to the ultimate goal of any DCF Excel model. Equity value divided by 4.2 billion shares equals a target value of the share of $71. That is a calculated share price that is very significantly higher than the share price in the market at the time of making this video. The conditional formatting in this final cell of the model is green when potential upside is expected and red when potential downside is expected. Remember what we discussed at the very start. A DCF Excel model is based on assumptions about the future. That future has not happened yet and will be much weirder than we can imagine. So don't take any DCF Excel model too seriously. It's entertaining, but can never provide you the absolute and one and only answer.